Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I am your host for about the next 20 minutes here on Options Guide TV. Today's date is April 17th. It is a Wednesday. The markets are open. They're rocking and rolling. We have a bunch of earnings that have came out, and the banks, I guess, to sum it up, well, you would say they're mixed. Some good news from Goldman Sachs and a lot of the banks that are not as interest rate focused, like Goldman Sachs, which does a lot of trading, a lot of investment banking, did well. The banks that are more interest rate focused, like JP Morgan, to name a few, didn't do as well. JP Morgan is usually considered the star in the group. And Charles Schwab also had a real strong showing. And a lot of the financials have at least, well, they tried to give a boost to the marketplace, but then the Fed decided to come out and be more wishy-washy. But they're wishy-washy for a reason, in that we have inflation trying to creep back in. It's kind of like, in my mind, with inflation, it's almost like a boxing match where you go down, you get the 10 count, you stand back up, right? And you're ready to go again. So we were knocking on the door of knocking out inflation, but at this point in time, it is not happening. So the data is saying that, once again, the consumer is still very strong. We still have good wage growth, and the market isn't happy about that. So if you look at the VIX in particular, the VIX is trading right now today. I'm surprised to see it up around that 18 level. So the VIX is definitely showing some nervousness in the marketplace. The SPX has sold off a little bit. And we did mention this on Monday's show, that the path of least resistance, as far as the markets are in general, would be to the downside. And hence on Monday, we actually looked at a skip strike butterfly in the SPX as an alternative to a short spread. So our legit outlook for the market for the week was neutral to bearish on the marketplace, and that trade's doing okay. And we're going to look at a quick review of that trade, but that's not the main focus today. So in the megatech stocks, Netflix is kicking it off on Thursday. Usually they used to talk a lot about the FANG stocks, and Netflix was a part of it. Now it's the Magnificent Seven that's making all the headlines, and they throw NVIDIA in there. But Netflix has really defied all the odds. There's still, when Disney came into streaming, everybody's like, oh, this is going to be the end of Netflix. Disney's going to be able to take over. But Netflix just keeps putting out more and more content, and good quality content overall. There's some debate maybe on that. But in general, Netflix has had a real strong showing so far this year. And it's kind of plateaued, just like a lot of the stocks. And the old adage, the seasonality of the marketplace, sell in May and go away. Well, that is happening right now. And the market is really struggling after a real strong, well, I shouldn't say a real strong beginning of the year. Now we're in April, and we have May right around the corner. April is now just saying to us, well, the market isn't happy at this stage, but it really has to do with the numbers. It has to do with what the Fed is seeing in the economy. It's what we're seeing happening with CPI and with the inflation numbers, and the market is just struggling. Okay, so we're going to do a speculative trade. And as always here on Options Guide TV, it's not meant to be a recommendation, but we're going to do one on Netflix, because Netflix is announcing on a Thursday, which means that we have one-day option contracts. And it's always a great learning experience when you have one-day options after a huge pump up in implied volatility. So in Netflix, I'm going to look at a skip strike butterfly. We're going to talk a little bit about the IWM trade that we mentioned on Monday that happened already. In other words, we were looking at something on Monday, but we ended up having the market take a big downturn in IWM. And it seems like with IWM and the Russell 2000 index and all the small cap stocks, They're all listening very closely to the Fed, and the run up has been based off of the fact that there was talk of as much as 7 rate cuts over the year. Now there's talk that there might not be any rate cuts whatsoever, and the probabilities of the rate cut coming in June have just took a huge dive, all the way from around 50% all the way down to 20% at this point in time. And even July is actually looking like there might not be a rate cut based off of the futures and the CME Fed Watch tool. So that was the trade that we set up on Monday, but it already happened in 2 days' time. So now I don't know if we want to go back into it, but I want to show you what happened in the chart. And let's start by doing the paper trade for this week. Let's look at Netflix. And I'm going to pull up, let's start by pulling up the chart in Netflix. Okay. So that's the IWM NFLX. So in Netflix, like I said, so far this year, it has been a very strong and steady growth, a very good stock overall. They've been able to beat off a lot of the competition. A lot of these big companies are realizing that the streaming wars are real and it's hard to get a foothold in. And Netflix obviously is the big player in this market space. And we're seeing a lot of consolidation right in here. And I'm going to zoom in on this little area. And we're coming right down. This is the 20-day moving average, and this is the 50-day moving average. Going into this earnings, I'm once again going to take the same outlook that we have in the SPX and the market in general, that we are neutral to bearish on an earnings forecast that is coming that is coming out. So I don't mind looking at a short call spread because of the pumped up implied volatility. But I don't want to do a short call spread around earnings because you never know, and you can get that more than one standard deviation move or a very large move to the upside in Netflix, and it can happen overnight as soon as they announce earnings. So I'd rather do a skip strike butterfly as an alternative and get it done for a net credit to the account. And if the market does come our way, well, we have 1 day for these option contracts to live. And hopefully you'd be able to get out at maybe even a nice little profit if the market actually goes up, as opposed to what would happen if you were in a short call spread, or i.e. a call credit spread. All right. So I think at this point, well, let me put the trade together and I'll talk a little bit more about that concept of a short spread versus the butterfly. We've done it before on Options Guide TV, but let's rehash it. We'll run over to the options playbook and we'll look at doing that. If you do have any questions, by the way, along the way, please do put them in the chat box. If you're in the Tradier YouTube platform, you can actually ask any questions. We'd love to make this as interactive as possible. So now let's take Netflix. Let's take where the underlying stock is at, and let's set up our skip strike butterfly. Okay, so if we go to the TradeHawk options grid, love the layout of the chains as always. We have all the different expirations. We're going to concentrate on that Friday expiration. Now, we're taping the show on Wednesday. We don't tape on Thursday. It's Thursday after the close. So a lot of times you might tweak this before the close if you were going to put it on in your real brokerage account as opposed to in a test trading account like we have here. But if you were looking to do that, you'd want to do it closer to the announcement because you're only trading the earnings today when we're looking at the Netflix trade. And if we scroll down, here's where the most at the money option contract is the 615 strike. And if you look at the long straddle, that'll give us kind of the expected move. The expected, well, not kind of, it would give us the expected move. The expected move here is about $54. So 27 plus 27, if we bought the call and we bought the put, that would be $54. So somewhere around that. It's not a exact science. So let's go in the middle. Let's call it 52. And then if you scroll all the way up, that's just short of a one standard deviation move. So you're looking at About the 665 strike is about the expected move. Now, remember, when they talk about the expected move and you look at what that means by the Friday expiration, the market, knowing that there is an earnings report, is pricing in about a 52-point move, and that effectively becomes the over under on. And you hear it from all the pundits saying, oh, Apple's expected to move X percent after earnings and Netflix to move X percent. Well, it's that simple. We're just looking at what the long straddle is at, and that's the expected move. I want to move further than that because I want to take our risk and make it hard for us to lose the maximum on this trade. It's still possible. You have earnings, you have Netflix, but I want to go beyond the expected move. We're going to actually go beyond the one standard deviation move before our actual risk kicks in. So expected move right around 665. 680 is the strike that we're going to buy. And what's awesome about, I have the options grid all set up to show you the one standard deviation move. It's going to be right around a 16 delta. And that's a plausible move. There's a decent probability of it reaching that strike. But it's not a high probability. And that's really what we're shooting for here. 680 is the one that we want to buy. We're going to go up 10 points, buy the 690. We're going to be skipping the 700. So the 700 is a nice round number, gives us a little bit of protection, but that's where our risk comes in. That's where our standard butterfly would be. And then we're going to buy the 710. So instead of paying, i.e., probably 50 cents to put on the standard butterfly, a net debit of 50 cents, we're going to bring in a net credit of 60 cents on this trade. So right now, the midpoint is about 60 cents. Now, we're going to add risk because we've skipped that strike. We've embedded that short call spread. So we did add risk to the trade, but it's well beyond a one standard deviation move that risk kicks in. So the probability of it reaching the 700 strike is around 11%. So there is still a chance based off of the math of the marketplace that it could happen. But the nice round number around 700 kind of helps us. The scariest thing would be a gap opening of more than a one standard deviation move. Like to say the market would gap open around this 690, 695 level. That would be, or even worse, up around the 730 level, which would mean that they blew everything away and that the marketplace is just taking off. And I kind of feel like there's obviously a lower probability of that happening. So we'll just leave it there. All right, so let's run to the what if calculator, and we'll make this our paper trade for today. This will be our official paper trade based off of earnings. And then next week we got a lot more earnings. We got Google, Amazon, Apple's coming soon. So we're going to be looking at just a lot of earnings trades that are always interesting to look at, and you learn a lot about them because that's when you learn about option pricing, when you get huge movements in implied volatility, not to mention the underlying stock. So that's what we're going to be looking at. All right, so what if calculator, here is our skip strike butterfly, and here's where the underlying stock is at. Let me zoom in a little bit more. All right, so here's where the underlying stock is at. Now, here's the big thing about the skip strike butterfly, and this is why we say you are neutral to bearish with a little bit of bullishness. So this is one of the most schizophrenic type trades in that in one way the market wants the market to stay where it's at. And it's okay if the market goes down because we did it for a net credit. All the options expire worthless. We make 69 cents or 59 cents. No big deal. The market goes up, it just can't go up right away. If it goes up right away, well, then it really hurts. And if it is going up, you do want implied volatility to come down, which usually happens, right? If the market is feeling more comfortable about where the stock is going, implied volatilities have a tendency to come in. And then ultimately, you need some time decay to happen. So to start with, once earnings are announced, implied volatilities will usually get cut in half, and that will help us out. But more importantly, let's watch what happens with time decay. So I'm going to pull up the calendar here, and we are right now on the 17th. Friday is the expiration date, but you also have to realize that implied volatility is going to come in also. So we're going to go from the 17th to the 18th. Now we're getting a little bit nicer on this profit and loss graph line, right? It's a little bit, we're okay if we do about half a standard deviation move. But then we get to Friday. Now, remember, we'd usually set this up on Thursday, but we get to Friday. And this would be 11 o'clock on Friday. Now, if we're anywhere within that range, we're looking really good. Ultimately, it could come up to this, and this will actually creep up higher on the profit side because implied volatility will also come down, which will help us out as we approach the expiration and the close on Friday. So this would be 11 o'clock on Friday. This is where the underlying stock is at. This is how we set this trade up. Looking to make, at worst case, if the market goes down this way, we make 60 cents. If we land somewhere in the middle here, we make 60 cents. If we land here, we can make up to 10 bucks on the trade, which if you ended up making $10, I kind of like to say you should get the stupid award for that, because that meant you rode it all the way to expiration and you just got lucky that it stopped right at 690 and you should have been out earlier. So even though you get that reward of selling this thing for a net credit of 10 cents, I still you should never be in it that long. And then the risk kicks in. So we're looking, here's where the one standard deviation move is, right about here. Oh, no, this would be about a 2 standard deviation move, right around the 700 level. And then that risk kicks in and you got $1,000 worth of risk if it jumps all the way up and you don't get the opportunity to get out. All right, so what we want to happen is the market to open somewhere in this range and slowly drift this way. That would be the ideal scenario. If the market goes down, oh well, one day the options are going to expire worthless. You make 60 cents on your trade, but interesting trade considering, and I've said this many times on Options Guide TV, considering the fact that Netflix is announcing on a Thursday. If this was a Tuesday and I didn't have Wednesday option contracts, which we don't at this point in time in Netflix, but if that's the case, well, I might not do this trade. I don't want to have 3 or 4 full days of trading where we could approach this and have this type of profit and loss graph. So let's jump back to the day to day, right? This is going to take a lot longer on Tuesday, if they announced, to get towards our peak of our skip strike butterfly. So very straightforward. And I do see we actually do have a few comments in here. One second. So all right, I sum that up. I don't know if I'm going to run over the options playbook. Let's just wait a second and let's try to address some of these questions. So, moral to my story, let's do the quick read back. The official paper trade for the day, and then I'll address these questions, is we are going to buy in Netflix the Friday expiration 419 call, the 680 strike. We're going to sell 2 of the 690 strike calls, same expiration, skip the 700 strike, and then buy the 710. We're going to do this for a net credit of 59 cents. It's at 62. Let's call it 60 just to make life simple. We could get filled at that midpoint of 60 cents. And our total risk on the trade is going to be $1,000 minus that net credit of $60. Don't forget commissions and fees. They're always important too. All right. Now that we got to the end of that, let's address some of the questions. So let's put the first one up that we have. And I'll just use the initials here. We'll say A. Hello, Brian. Could you please do some more trades in future videos with other stocks other than Netflix around their earnings too? Yeah, that's the plan. Usually when we get into earnings season, I like to focus on earnings trades, not necessarily because I just want to trade earnings. It's more so that you learn so much about option pricing and setting up strategies and everything around earnings, because you get that quick hit. We put it together on a Wednesday, and we know on Friday what happened. And you can explain what happened to the trade, even if it's a winner or a loser. But we are definitely going to look into earnings. And if you have one in particular that you'd like to talk about, go ahead and throw it in the comments, or you can throw it in the chat box, and I'll try to address it. And I'll work on that one in particular, maybe this Friday, or if it happens to be on the day that we tape Options Guy TV, I can do that. I've been enjoying your videos and finally found a way to use the live chat option. All right, I know that was a little bit tricky. I agree with that. We're gonna do a little better with that. Please look into other trades from your book, for example, long or short straddles. Okay, well, on Monday's show, that's a great segue. And then I also see one from Wayne. We'll do the Wayne one in just a second. But let's jump back. We got about 9 minutes left. Let's talk about the long straddle because you brought it up, AE, I guess, would be the initials. And if we let's run back, let's look at the TradeHawk software because I mentioned it, but I didn't pull the trigger. So that's why IWM was up, the Russell 2000 index. We have been doing some long straddles. Let's start by going out in time here. So let's go days. Let's go 1,200 days. Okay. And we talked a lot about the Russell, the fact that the Russell usually isn't a good stock technically when you look at the charts because it's just all over the place. But there was a definite defined channel that it had. And all of a sudden it started to play nice as far as the charts are concerned. So down here, we did a long straddle saying it's either going to break to the downside because it was 1, 2, this was the third time of touching, or it was going to take off. So the call obviously paid off. Then we got in the middle of this right in here, right around 197.50 actually is where we were at, and said, well, let's do another long straddle. And it did run up, but if you missed the opportunity, it came back down. And right now, really and I mentioned it on the top of the show, the Russell is following what the Fed is doing. If the Fed makes you feel like they're going to do some rate cuts, the Russell goes up. If the marketplace feels like the rate cuts are not going to happen, the marketplace goes down. And so I'm going to zoom into this little area that I was looking at. And on last week's show, we talked in particular, we were right here. So that would have been 2 days ago, right here, right in this range. We were right around here, and said it might be time to buy another long straddle because once again, the marketplace has this huge gap, not to mention it goes all the way down to this. And we ended up actually filling that gap all the way down to this corner right here. So it did happen, and we talked about it, but didn't pull the trigger on Monday. And then you got the 200-day moving average, the path of least resistance right now that it's broken out of that little channel to the downside, is to this range right here. So at this precipice in the charting, I would have been interested in a long straddle. And that's the moral to my story. Is if you're talking about a long straddle, I don't like to do long straddles because of an event, because I know they're announcing earnings. Well, the whole marketplace knows, so you're going to pay for it. And usually those straddles don't work out because implied volatility crunches and you have too many factors going against you. In this situation, I would rather look at a long straddle because I'm doing it based off of the chart. I'm doing it based off of something we see in the chart. Like this one, and then, I don't want to just talk about winners, right? In general, you don't, because it's not always the case. But when you look at, refresh it. But when you look at this chart, 1200, go back, right here, there was obviously something that was going to happen. You could say that it was a breakdown or breakup, but of the long straddle, they're not that expensive in the Russell 2000. Just because in general, you're talking about an index of 2,000 stocks. So implied volatility may be highish, right? Because they're volatile stock, but it's still muted by the fact that it's an index, or i.e. an ETF that tracks an index. So right there was a very interesting time and space to do it. And you happy to go back and look at that if you would be more interested in it. Okay, 5 more minutes. Where are we at, Wayne? What do we got? So longtime listener, to the show is Wayne. Wayne was an original customer about 20 years ago, if I remember right, Lane. All right, let's go ahead and throw that one up. Hey, if you were bullish on Netflix for earnings, would you do the skip strike butterfly with puts instead? Yes, I would. And you can. You can do it the opposite way. So that's an alternative to a short put spread, Wayne. If you're looking at it, you'd be an alternative to a short put spread. But the downside with the put side of things is if the markets go down, implied volatility goes up. So it makes it harder on the downside to be profitable if the market goes the opposite direction. So I prefer on the downside to do something different if I was bullish on Netflix. Now, I'd be much more apt to maybe just sell the put spread, but then you have a lot of that risk that's involved on that trade. But I would probably just do a long call spread and I would straddle the market. I'd rather be in a long call spread, manage my risk. It's not going to be, quite the same, but I don't like skip strikes as much on the downside because implied volatilities have a tendency to increase as you go down, and the butterfly that's embedded in the trade doesn't help you as much. So if you're wrong about your forecast, it's not as enticing to be wrong on Netflix if the market comes down. I don't mind it, and I could look at one, but you'll see that we won't be able to get it done for as nice of a net credit when you're on the downside, just because of the way the skewing is. But we've got a couple of minutes. Let's toss it in there. Okay. So one standard deviation, Trade Hawk option grid makes it very simple to do this. Go to the downside. We're right here. So that's the 14 delta. So the 16 delta. So it's right in between. We'd want the delta to be somewhere around 16. So I guess let's look at this one. Okay. Because I know it's going to be a little tough to get it done for a net credit. For a decent net credit, I should say. So we'll buy let's do the 550s. The math is simple, okay? Buy the 550s, sell 2 of the 540s, skip the 530s, and buy the 520s. All right, so the credit is a lot less. Well, yeah, it's cut in half. I guess I would say a lot. So it's 28 cents, and that deals with the fact that if you this option contract that you're buying here is trading for 136 implied volatility, and as you go down, it starts to creep up, and this is at 138. On the call side of things, it'll be the exact opposite. If you come all the way out here, as you go up on the call side of things, implied volatility. Now, this is a totally different lecture in general, but implied volatility start to go down. So it makes it easier to buy that last wing as protection because implied volatilities are going down and the options are getting cheaper. And for that fact alone, this is trading for 28 cents, where on the call side of things, it was trading for 60 cents. But I can go back and show you the legs. Don't mind it. I just like it better on the call side of things. Moral to the story. That was a long-winded answer. All right. Well, we're at time. Oh, one last one. All right. I'm entering into the Viewer Hall of Fame. Well, I would agree, Wayne. That's definitely. I've been around for I think three different companies now that I've actually lectured for. So at that point in time, so I do appreciate all the questions. They're always good questions, and I do always appreciate it, Wayne. That's it for this episode of Options Guy TV. We'll be here Friday. Very interesting day. We'll see what happens in Netflix and our skip strike butterfly. And if you're in the Tradier YouTube channel, please click subscribe, ring the bell, make sure you get all the alerts, and we'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.